Economics is politics. That's the theme of the talk. That's the theme of the conversation I am about to have with a former Fed insider, someone who actually worked inside the Federal Reserve. And we are going to dig into what economics is politics. What does that mean? Well, to understand where the economy is going, you have to understand who the people are and what are driving their decisions. We're going to talk about inflation, what's really caused inflation, what the Fed is really seeing about inflation. We're going to talk about the Fed hiking the rates, the yield curve control. The 530 yield was just inverted. We're going to talk about that, what that means. We're going to talk about saving the dollar or saving the economy. The Fed is between the proverbial rock and a hard place. We're going to talk about that. The insider trading scandal from the Federal Reserve, was that really the Biden administration trying to move people out to bring people in? The change of the LIBOR and the SOFR index, of course, Russia, Ukraine, what this means for the death of the dollar as the reserve currency, and so many other things. I'm talking about having a conversation with Danielle DiMartino Booth. She worked inside the Fed. She's the author of the book Fed Up. She's also going to be a speaker at the MarketDisruptorsLive.com event. There's a link down below. It's my event that I'm hosting. I've invited Danielle to come talk and explain what she thinks is going to happen over the next couple of years and what you should be doing about it for your money to build, grow, and protect your wealth. She focuses on these subjects. She's somebody that I value her opinion. It was a great conversation. Don't miss out on seeing her live, meeting her live, MarketDisruptorsLive.com. There's a link down below. And with that, let's go ahead and just jump right into the conversation. Danielle, I'm so excited for this interview. Second time you're back on the show. The first one did amazingly well, and I'm sure this one will as well. So anyway, thanks for joining me again today.
Great to be here. Thanks for having me.
So we were talking about a couple of things before we started recording, and it wasn't on my list of things to talk about, but I thought we would. So something that you've been talking a lot about is economics is politics. What does that mean?
Well, it means that even though we think we would like to separate the two, kind of like church and state, it's become increasingly impossible. The fiscal stimulus measures undertaken after COVID, they're what sowed the seeds of inflation, because we'd had supply chain disruption going back to the first Trump tweet years ago. And the supply chain disruption just got all the much worse. But the new element really was fiscal spending to the extent of 43.2% of GDP injected into the veins of the economy directly, to like direct deposit. And that's a game changer that people have to appreciate, especially because the Fed monetized all of that debt. So that's another, just to put the 43.2% in context, the entire New Deal, World War II leading up to, all of that was 40.1% of GDP.
Right.
So we actually did something of a greater magnitude. And again, the Fed monetized it in a zero interest rate environment and ignited the mother of all inflations. Because when you give people with the greatest propensity cash money to spend, lo and behold, they're going to spend it.
Right.
And they've spent it. End of story. The saving rate, the amount of savings is actually below that of what it was prior to the pandemic, ironically, as inflation eats away at people's incomes.
Yeah. So typically we would say that high prices are the cure for high prices. But when people have so much extra money and prices are going up, they don't seem to care, right? So going back to kind of what you said, supply chains, they may want to blame supply chains on this inflation and prices going up because they've broken down. But then why? Why have supply chains been so overstretched? Well, because of all the increased demand from all the extra money, right?
That's exactly right. I mean, for there to be in the background a city the size of Shanghai effectively shutting down its financial district and nobody being really worried. Nobody's worried because the ports are no longer disrupted. They're not on the front page anymore. They're not garnering headlines because tankers aren't sitting in the middle of the Pacific Ocean waiting for days and days and days and days.
Right.
And that's a factor of the demand pull coming back because people don't have the same amount of money. That's what that is. So you're absolutely right. And you pinpointed something that is a huge pet peeve of mine with the supply chain disruptors. And that's that if you don't have the demand pulling it, really, it's a moot point.
Right. Yeah. So going back to economics is politics, then you can't really understand economics without understanding the politics of it, because these are policy decisions they're making that are driving this. So going back to this, these policy decisions, they wanted to send out a lot of money for stimulus to kind of help the markets. And now we have these big midterms coming up. People are expecting a lot of fireworks because of that. And we maybe are starting to see some policy decisions being made that might be trying one side of the party trying to do what they can to keep their vote going, I guess. And so we had talked about like going into this midterm election here later this year, lots of things are seeming to change, but one of them is all of a sudden this debt limit, debt ceiling has been resurfaced. Do you think that has something to do with it?
Well, I mean, to be, to basically effectively be in April and then have a headline cross that says debt ceiling is going to be hit on, at the very beginning of October. You're like, okay, wait a minute. Why are they putting this headline out there right now? I mean, who's it going to benefit or not? And, if we're theoretically in recession, which is very much feasible going into that final quarter of 2022, my favorite macroeconomic number cruncher, his model shows that GDP for the first quarter, his estimate's down to 0.1%.
Who's that?
Ben Herzon. He used to be macroeconomic advisors. They were bought out by IHS Markit. IHS Markit was subsequently bought out by S&P Global. So it's technically S&P Global's Q1 GDP forecast of being 0.1%.
Wow.
So and again, this guy, his model is straight down the middle. It is super objective. It just pulls in every bit of data and compiles it. He was at 7.2%, 7.1% for the fourth quarter of 2021. He's very data agnostic, which is why I like him. There's no agenda that drives his model, which is what tells you that if you've got something that if you blow the air, boom, you're in negative territory. That's how close we are to recession, with the yield curve being at its flattest point.
Yeah. I love what you just said there about really trying to look through the data and then ask yourself why they're saying it. So in today's world, we used to have a problem getting information. Today, we have too much information. So a lot of people are missing that critical thinking aspect, which is like, who's telling me this? What are the facts? And then what's the story they're telling about it? And then so you can learn how to parse that information and look for information. It's a tough skill these days.
There are unfortunately too many bad actors on Twitter who paint such persuasive cases that people are like, well, that person sounds really smart. They must be right. And you're like, yeah, but they're like missing a critical component. They're like leaving out, they're cherry picking the data. You can't look at it through just that prism.
Right.
It's, all the yield curve apologists right now. You can only look at the 3-month 10-year. It's the only determinant of recession. Well, okay, but the Federal Reserve controls the 3-month rate. So if you're saying that the economy can only be in recession after that yield curve inverts, that means that the Fed has to raise interest rates by 225 basis points very soon for it to invert. Or you could look at the 2-year 10-year, which is at 13 basis points, which is telling you, what the part of the yield curve that the Fed cannot control is communicating to you what the market believes is going to come to pass. And that's why I always say that there are very few honest players in the financial markets. The bond market is one of them.
Yeah. So jumping into the yield curve control, at the time of this recording, it's March 28th. And we just saw today the 5 and 30 inverted. And so that's turning into memes all across the Twitterverse, FinTwit, if you will. And everyone's talking about that, this 530 being inverted. And to your point, there's multiple yield curves that you could look at. But more specifically, I want to ask you about, a couple questions I want to ask you about that. One, I guess, people start talking about yield curve control, and at what point does the Fed step in and do yield curve control? But before I even get to that question, I would ask you, isn't the Fed already controlling the yield curve at some point, because they're actively buying those bonds, and by actively buying those bonds, they're pulling that price down anyway?
Well, that certainly was the case before they finished buying the bonds. And boy, there's nothing that gets the people on my Twitter feed more agitated than if they see that the Fed's balance sheet has ticked up by this many $1 billion. I'm like, well, it takes mortgage-backed securities in some cases 3 months to settle. So we're just going to have to calm down here. The Fed really is out of the business of actively growing its balance sheet.
Okay.
And to your question, though, the Fed right now is in discussions to shrink the balance sheet.
Right.
So to use the example of yield curve control, the Bank of Japan came out and said, we're going to buy as many 10 years as we need to buy in order to make sure that that yield stays below a certain ceiling.
Right.
And the Bank of Japan did that. But the Bank of Japan is still in a, wait for it, easing mode.
Right.
So it's pretty damn hard for the Fed to announce that it's going to be undertaking easing policies in the middle of a tightening campaign. And, by the same token, I have another contingency on my Twitter feed that says, well, why doesn't the Fed just sell the 10-year if it wants to uninvert the curve? If it sells the longer dated treasuries off of its balance sheet, then it can bring those yields up.
Right.
They can go up above the 2-year and 3-year treasury rate. They can forcibly uninvert the curve. Well, I mean, if you really want to slam the real economy, go ahead and sell those longer dated treasuries and see how that treats interest rate sensitive parts of the economy that are already slowing. See what that does to mortgage rates. See what that does to car loans.
Hasn't the Fed been selling a lot of their longer term bonds and rolling them into more shorter term? I mean, that's something they've been doing over the period, for a while.
Well, when the Fed engaged in the moment of Operation Twist, it was with the aim of loosening monetary policy. But again, there were two operations going on at the same time.
Right.
Right now, the aim is specifically to allow just what is organically going to mature to come off the balance sheet. That's it. And that means paper that matures. The Fed owns $1 trillion of paper that matures between now and 2023. That's plenty of
yeah.
When you consider quantitative tightening, when you consider how little they were able to accomplish the first time they tried.
Yeah. So the first time they tried, you going back to 2018?
Yes.
When they tried. Yeah. I want to talk about that. But before we get into the 2018, the last time they tried. So inflation, we've seen inflation going from not a problem to transitory to not transitory to Powell admitted that the Fed is responsible, at least partly responsible for inflation, to then it's Putin's fault. Needless to say, we have inflation, energy prices, food prices, asset prices. And it looks like the Fed has to do something with that. First of all, I think based off of kind of what we said earlier, with supply chains breaking down and whatnot, would you consider this inflation, at least in energy and food prices, to be problematic and not transitory, but long-term?
Well, when you've got farmers in the Midwest saying that they're going to change their crops out because they can't get the right kind of fertilizer in hand.
Yep.
And when you've got small trucking firms saying that they're going to be pulling the plug on operations until diesel prices go down, which is going to elongate your supply time from farm to market. These are things that can really start to monkey with inflation.
Yep.
And we have to bear in mind the February CPI data was collected prior to Putin's invasion of Ukraine.
Right.
So we already had this massive gap up in gasoline prices before the first tank crossed the border.
Yep.
So, and you know what? Crude prices have come down, but they're still extraordinarily high. And your gasoline price, which is what consumers, it's the most visible form of inflation and what they see. And by the way, you've got this whole crop of millennials who've like squandered out to the exurbs and suburbs, many of whom are being called back into the office. They're like, okay, wait a minute, hold on. I didn't sign up for this. I've got a car payment. I've got a house payment. I've got property taxes. Now my gas bill to get back and forth to the office when I thought I was going to be working from home forever, that's going up too. And by the way, the food, the cost to put the food on the table, and I've had kids now that I live out in the exurbs. So this is throwing budgets of not just your most susceptible families, but the budgets of working, middle income working Americans. This is really messing with their budgets.
Yeah, it's big time. And it looks like, we've seen this coming for a while, at least those of us that are paying attention to what's happening. But we're in this situation where it seems like the Fed has, the central bankers have been kind of stuck between this rock and a hard place, proverbial rock and a hard place, where they can continue to stimulate, continue to ease, continue to try to keep the economy going, the markets up, but then inflation's raging out of control. The flip side is they try to start tapering and risk blowing up the market, but bringing inflation back under control. And it seems like there's been this balance, trying to figure out what they can do. If I look back through like a historical lens, it looks like when Volcker was kind of faced with the same situation, he chose to sacrifice the economy to save the dollar. Maybe Bernanke chose to sacrifice the dollar to save the economy. And now maybe Powell is stuck with a similar decision. Would you frame it up that way, or am I looking at it wrong?
Well, I think Bernanke saved the markets at the expense of the long-term growth of the economy. I mean, he was at the helm of the Fed during one of the most sclerotic, anemic phases of expansion in U.S. history. And that's what happens when you throw good money after bad, is you elevate asset prices, but companies are trained to not invest in the long-term growth of their companies. They're trained to do other things like buy back their shares, which pump up their their bonuses, which is great and convenient. And in fact, we have seen fixed investment outside of software spending come tumbling down these last few years. And of course, software spending is a really polite way to say automating jobs out of existence.
Yeah.
And that's something else that you don't talk about in the midst of millions and millions of job openings. I'm like, well, yeah, there's a reason that offices are not filling back up.
Right.
And it's not just people working from home. That percentage has dropped from, I think it was close to 30% in the heat of the pandemic down to like 13%. So there is something to be filled in, and that is automation being expedited. And again, these are things that are just not the subject of polite cocktail party conversation.
Yeah, for sure. I was trying to pull up, but I don't remember exactly, but there's a quote from Vladimir Lenin. I believe it was John Maynard Keynes was quoting Vladimir Lenin. He said that the best way to debauch or the best way to destroy capitalism is to debauch its currency. And through a series of inflation, then you can steal wealth through an arbitrary means. And at the end, he says that through a series of inflation and deflation, the currency and the system would have lost all its order, that the best way to get wealth would be through gambling. And so that quote makes me think about what you were just saying, which is over the last couple of years, they haven't been reinvesting. We haven't been getting real products and goods being produced. A lot of it's just been put into the markets, buying back their own stocks, gambling, right? That the future will be higher, something like that. Kind of prophetic.
It is. And it's kind of sad, because when you think about the headlines that have faded, and that's that we're not pharmaceutically independent. We're not even energy independent, because the energy industry has had their wrists slapped for so long that even when it was very profitable to make investments, they've decided to err with shareholder value instead. And that's the direction that they've chosen instead. So, if you're told ESG is going to put you out of existence, inside 15 years,
what are you going to do?
You're not going to build a refinery that you write off over a period of 25 years for purposes of accounting. The last refinery built in the United States that's up and running today and functioning as a gigantic, huge refinery was in 1977.
Yeah.
So these are massive long-term investments, but we're not independent in certain industries in which we should be. And it seems like the beginning of the pandemic has faded very fast into the background, and that we've forgotten these things.
So that goes back to what you opened up with economics is politics. And so a lot of these political policies have been put in place that are then long-term damaging the economy, in a sense, back to the energy. For the last decade, politics has been telling the energy sector that we want to put you out of business. Biden appointed a OCC person that said literally they want to make them bankrupt. And so what company would reinvest back into themselves, long-term commitments, R&D, et cetera, when they're being told they want to be put out of business? And so that's the policy driving the markets kind of a thing.
Exactly right. And, the other elephant in the room is nobody wants to acknowledge the damage that you do to the economy in order to extract the materials needed to create an electric vehicle.
Right.
And it's just,
it's a big problem.
Again, this is not the stuff of polite conversation, but if you really want to see a chart that's taken off, look at lithium prices.
Yep.
And what's happened to them. So there's nothing elegant about this. You know, the most optimistic forecast that I see suggests that maybe 15 years from now, 5 years from now, we might be, you know, kind of electric vehicle, you know, that kind of a country, maybe, but these are people playing with spreadsheets.
Yeah.
And, you know, I saw a 65 Corvette Stinger go by a few days ago with the top down on a beautiful Chamber of Commerce day. And I'm like, that's not going away in 15 years. That's going to get more expensive with time.
Yeah. I want to put a pin in that and come back to it if we have time, because I want to talk to you about that and maybe another thing I saw you tweet out. But it did make me think of a video I did about a year ago where I talked about this transition to EVs and the Tesla Gigawatt Factory, which is the largest battery manufacturer and manufacturing facility. It would take them 5,000 years to make enough batteries to store the energy of the United States for one single day. And because renewables are inconsistent, if it's not sunny, you know, we have to probably store for 5 days or 7 days. So 5,000 years for one day. So anyway, we'll put a pin and come back to that. But I want to go back to where we talked about Powell. Well, the last time that the Fed really tried to taper down, 2018. So if there was this proverbial rock in a hard place that maybe the Fed finds themselves in, keep stimulating the markets or save the dollar, and let the market crash. If we look at Powell, so in 2018, when he first came in, he came in all fired up, wanting to get the job done. And that's when they tried tapering, which didn't really work out too well.
Mm-hmm.
So was that do you think when he came in, he wanted to set it straight? He was, you know, fired up to get the job done. And maybe he's been hawkish from the beginning.
He has been hawkish. He was hawkish in the very beginning, in his first congressional testimony. He was extremely adamant in saying it's not my job to backstop the stock market. And the stock market didn't like it one bit.
Right.
What stopped Powell in his tracks was the credit market. And, you know, that's the story of 2018 wasn't necessarily Volmageddon when an ETF priced off of volatility blew up his first day in office in 2018, sending the Dow Jones down more than 1,000 points. That wasn't what scared him. What scared him was when the credit market shut down.
Okay. And
you've got globally non-financial debt that's retiring, that has to be rolled over in 2022, is about $1 trillion. That's not like we can talk about it theoretically. That's going to be coming around in 2025 or 2026. And that wall of maturity is way out there over the horizon.
Right.
It's now, and it's bigger next year in 2023. So making sure that these companies stay alive, that's what really got Powell's attention in late 2018. That's what triggered the pivot. That, you don't have 41 days of consecutive, you don't have 41 consecutive days in which not a single junk bond in the United States is sold. The wheels fall off really quickly, and then you start to flirt with systemic risk.
Sure.
I do think that Powell is going to let more damage occur because of inflation than he would have a few years ago. He can't let systemic risk become unleashed. He can't let the credit markets go. And he's trying to find mechanisms to, in fact, control trading in fixed income markets if prices swing too far. That's not law yet. But he's looking at things that are effectively bond market circuit breakers.
Right.
But in the interim, I think he's willing to let the stock market fall more than what is perceived, because it's a midterm election year. And there are politicians from both sides of the aisle saying inflation is too high and it's eating away at our constituents' budgets. And so that's, you have to pay heed to the fact that whether you're talking about Alan Greenspan in 1987 or him, the same man in 2000, Bernanke with the housing crisis, they were in falling inflation environments. So they had a lot more optionality, a lot more flexibility than Powell has.
Right.
And that's just a simple fact of life.
And even when Powell tried to do this back in 2018, though, we didn't have the raging inflation that we have today. So he was trying to taper down the Fed without the inflation. And now today he's wanting to taper down the Fed, but we have the inflation. So I guess he just has even more motivation to try and get it done today, even though it probably puts us into a much worse situation as far as the markets go.
You know what? We'll see.
Yeah, we'll
I
see.
know that there's been a lot of tough talk. I know it. If Powell was really concerned, he would have done something the first time the headline CPI printed north of 7%.
Right.
And that's what Jim Bullard and others were suggesting, that it would be appropriate during unusual times like that to come out with an intermeeting rate hike. He chose not to. Fed speakers have said that it's, that the balance sheet runoff is imminent. And yet, Christopher Waller, who's fairly new to the Board of Governors, he came out the day after the most recent Fed meeting and said, we said in coming months that we would be running off the balance sheet. That might be July. So for all the tough talk, it's going to be 0.5 point hikes. It's a whole different regime. Volker's back. He's come back from the grave. All I've seen so far is 25 basis points.
Right.
That's all I've seen.
So we've only seen 25 basis points. Obviously, the dot map is pretty aggressive. Do you think we'll see more? I mean, do you think they'll be able to get through those, or we'll take it one dot at a time?
I mean, it really remains to be seen what the feedback mechanism is between risky asset prices and the real economy.
Right.
Look, we have University of Michigan consumer sentiment and expectations down at the lowest level in more than a decade. You have income expectations as reflected through University of Michigan sentiment at the lowest level in data going back to 1940. So, hopefully none of this comes to fruition. Hopefully these are just sentiment gauges, but they're also being led by people who make $100,000 or more.
Right.
So even though the S&P 500 might be, just 5% off its highs or whatever, that doesn't mean that if you're Joe Q401k, it's not making you nervous to see your net worth jump around all over the place. So
right.
Again, yeah, I think the way you said it is best. We might just be going on a dot by dot basis, because we don't know if the economy is in. Volcker put the economy into a deep, nasty, dark recession.
Right.
And I don't know that anybody on that committee is Volcker.
But did he do that to save the dollar? To save the dollar for the world?
He did it to break the back of inflation.
Break the back of inflation. But did it save the dollar by strengthening the dollar in the world, and the reserve status of the dollar, do you think?
Well, had he just sat back and allowed runaway inflation, then you could have, seen a repeat of the Weimar Republic.
Right.
And that didn't go very well.
Exactly.
But the Fed's duty has nothing to do with the US dollar. Zero. That's by law. That is the purview of the US Treasury, the US Department of Treasury. They do have a dual mandate, but back when Volcker was in office, the employment mandate was a fairly new thing, and his focus was on inflation.
Got it.
And getting that under control, come what may. Now, does the dollar obviously benefit from such strong maneuvers? Of course it did. And did Bernanke setting a 2% inflation target, was that de facto saying, I want for your dollar to disappear after 50 years? And this is a hideous, insane, stupid goal. But again, for all the gnashing of the teeth, Ben Bernanke set that 2% inflation target. It was put in place in January of 2012. And by the Fed's favorite gauge, they managed to hit that target 11 times between January of 2012 and when the pandemic hit and inflation took off. So clearly, if that was their goal, if that was their target, they would have been fired a long time ago, because they couldn't create inflation out of a bag outside of risky asset inflation.
Right.
But you throw the fiscal authorities in there and you get back to economics and politics.
Let's get back to economics and politics. So back to economics and politics. So I'm sure there's what you want to have happen, and what you're dealing with in the short term. So they may have these goals and policies they're driving towards, but then you kind of have to take it one dot at a time, kind of back to that point, right? So like, here's where we'd like to go, but based off of the situation, we kind of have to do this. But if we look back to where they want to go, back to economics and politics, it seems like maybe there's been this pivot with Powell. So like I said, came in 2018, hawkish, trying to taper down. And then we saw recently Powell kind of admit that the Fed was responsible for inflation and that they need to take aggressive action. Seemed pretty hawkish. He made a statement that there was room for 2 reserve currencies, which I think was pretty interesting. And it looks like Powell, and then you mentioned the EV vehicles and this push for going green that seems to be happening, especially out of the, let's call it the ECB crowd, the European Central Bank crowd, the Euro crowd. And it seems like maybe Powell is maybe breaking from what that is going. Do you see that he's kind of pivoting and maybe trying to break away from that in a sense? Or I guess you said he's always been hawkish.
When it comes to thorny subjects like climate change and central banking, I will say that Powell has been a rational voice in the wilderness and has said, we really don't have the tools to deal with that, which right. The Fed does not.
They have money.
They have money, they do. But again, Powell does a really good job of saying F you.
Right.
In congressional testimony. He's actually quite good at it. He's like, we'll get back to you. You know what? We've got that out for comments, for public comments. We're discussing that right now. But he's been saying the same thing about central bank digital currency. He's been saying the same thing about negative interest rates. It's under consideration.
Right.
We'll check back with us in a few weeks. Leave a message. So that to me is, as critical as I have been of Jay Powell, his effectively holding the line on so many of these Rubicons that need not be crossed in the purview of central bankers in the shadow of what the ECB is trying to push for is, thank God we've got a rational person in charge,
right?
At least in the sense of understanding his limitations.
Yeah. Yeah. I mean, it looks like that to me, to your point, like he's the proverbial FU, to the crowd. We saw, it looked like, there was a FOMC meeting back in June of last year that was forecast to be kind of nothing. And it seemed like in there, he had maybe a week or two before, he had like a argument with Christine Lagarde where she was talking about, supporting these green initiatives. And Powell said, hey, look, that's not up to the Fed, right? That's not our deal. And then in that meeting, that seemed to be nothing was going to happen in June. It was June 21st. And then they raised the reverse repo window 5 basis points, which seemed to start draining liquidity out of the euro dollar market. Like almost like, you know what, we're going to go do what's best for us and the dollar over here and like kind of forget what the ECB is doing over there. Is there anything in that, or am I looking into that too deep?
In terms of central banks retaliating against one another,
not retaliating, but just saying we're going to do us and you do you, as opposed to like, we're going to go along for the ride and push this green initiative.
Well, also you have to understand that at the time there was great concern that overnight rates were going to turn negative. So they actually needed to make some moves for the functionality of the United States financial system at the time. If there was any kind of a blowback in Europe, so be it. But at least in my experience, what I have seen is coordination for the good, or at least what they perceive the good to be. And I'm certainly not talking about climate initiatives. I'm just talking about we better get our swap lines lined up so nobody has a freeze in the markets. So I've definitely seen central banks coordinate with one another for what they consider to be virtuous causes. I've never seen any motivation, just because they're typically boring academics, any motivation to do anything preemptively against another one. In fact, I think one of the biggest criticisms of the Fed should be that it is a reactionary body. And had they thought through better, we're monetizing 43.2% of US GDP that's going directly into the hands of the people. We might be co-conspirators in igniting the mother of all inflations Had they thought that one through, they might have thought twice about being the facilitators and monetizing all that debt. They didn't. They're reactionary.
Right. Yeah, I guess my point wasn't so much as them being vindictive or retaliatory in any way. Rather, just as you kind of made this statement that Powell is kind of good about telling people to take a hike or whatever. Maybe what I was saying is just maybe there's more of a view where like, hey, we're going to like really focus on the U.S. and the dollar and our U.S. markets right now and not really play along or be so concerned with what these globalist agendas are. I guess that's kind of what I was asking.
I mean, that's Powell's personality, period. Anyways, remember,
Okay.
he's a Republican.
So
I mean, how you come into the Fed, matters. Remember,
right.
Bernanke renounced his being a member of the Republican Party after he left office. So Powell has yet to shed his conservatism.
So what does that mean? He came in as a Republican. Explain that.
Well, even though it's supposed to be an apolitical, independent entity, it doesn't change the man who walked through the door as having been a Republican, a card-carrying Republican when he was confirmed by the Senate. The only reason he was nominated in the first place was because Obama was trying to get in who he really wanted onto the board, Jeremy Stein at the time, when he nominated the two in 2011. That is customary presidential behavior. Not that we can recall what customary presidential behavior in one sentence means with one person anymore.
Right.
Because Trump was off the rails nuts when it came to the Fed. Here we've got Biden trying to get four Democrats for the price of one Republican. But back in the days of cordiality, Democratic or a Republican president, if they wanted to put somebody in on the Federal Reserve Board, they might nominate somebody from their own party. And to sweeten the proposition for the opposing party in the Senate, they would nominate somebody who would be considered to be a centrist from the other party. And that way they would for sure get their candidate in. Now you've got, Biden trying to get in all these climate control people at the same time. I've never seen anything like this.
Yeah. And that's kind of what I'm kind of trying to allude to, like this globalist centric view of the world working together in these green policies and what Biden's doing. Whereas it looks like Powell is like not having any of that. And he's kind of being more U.S. market, Wall Street bank centric.
He's definitely more U.S. economy centric.
Right. Right. Then why would Biden have kept Powell in?
Oh, well, that was really bloody at the time. And I don't think he had a choice.
He didn't have a choice.
Every single time he tried to force Lael Brainerd on the markets threw up.
Yeah.
I mean, I literally have the two lines on a graph. You can annotate them in the graph. So he insisted on saying that Powell was not going to be a shoo-in, and the markets just went voom. And then it looked like Powell was going to get the nomination. We were following it and predicted online. And then one day he had Lael Brainerd up to the hill, and the markets went voom. And so, I mean, I'm sure the people who are advising him are going, well, okay, it's Obama in 2010, let's see, he lost 8 senators, he lost 63 House members, swung to the other party. Let's see what happens if we change the Fed chair, tank the stock market, and go into recession at the same time. How do you think 2020 is going to work out there, sir, period? So I think Biden was forced to step back. But while he did step back, then he nominated all of these other people to the board. So including Sarah Bloom Raskin, who has since had to step down from the nomination process. It does not look like Pat Toomey, who's on the Senate Banking Committee. The Senate Banking Committee split straight down the middle, 12-12, which means that Lisa Cook, who has also advocated for central banking, trying to have a hand in climate change, it does not look like her Senate confirmation is going to go smoothly either. So Powell should be a shoo-in. Lael Brainerd she's not going to have a great vote, but she'll make it. It looks like Jefferson would be a go, but it looks like the second person who was specifically advocating for climate change, I don't know that she's going to get through the Senate confirmation hearing.
Do you think the Fed insider trading scandal has anything to do with that? And we had I believe it was 3 people had to step down. One, I think from your own Dallas Fed, Robert Kaplan, Richard Clarita, Boston Fed, Eric Rosengren, they had to step down. They appeared to be very hawkish, if I might say that, those 3. Was there anything about that being exposed and them trying to get pushed out that were more hawkish to maybe make room for some of these people? I know we're getting into assumptions and opinions, but I guess all of this is kind of is. But politics is economics, right?
Politics is economics. And I was not a fly on the wall. It was, that said, Kaplan in particular, his trades were enormous. And so were Claritas. Rosengren's, not so much compared to those two. He wasn't slapping around $5 million trades at a time. When I was inside the Fed and I had class 1 clearance, in a million years, I would have never been permitted to trade in such a way.
Right.
So to me, the biggest shame is that the Boston Fed has had such a tradition of centrists, of monetary policy centrists, and Rosengren was indeed considered to be hawkish, but it wasn't like crazy uber hawkish like Kaplan was. But he definitely had a good feel for the banking system, for the practical side of the economy, he had an appreciation for how monetary policy played out in the financial system. He had a huge eye on commercial real estate and how concentrated those loans are on the books of small and mid-sized banks. He would have been the perfect person for supervision and regulation for that chair. And to see him get booted out, and again, how tiny his trades were compared to the other two, and then have him replaced by somebody from what I call the MIT Mafia. And that's about as liberal as you can get.
What's the MIT Mafia?
It's my nickname for the it's in my book Fed Up. It's my nickname for the Fed staffers in Washington DC who control the narrative. Okay. Regardless of who's sitting around the table, leadership, district bank. I mean, as far as they're concerned, district bank presidents, they come, they go. They're the staffers, they're lifers, and they control the narrative. But they took somebody out of that same tribe and put them in as president of the of the Boston Fed. Dallas Fed does not have a replacement, but of the Boston Fed. And I considered that to be a shame, because Rosengren was a good man and he did good work.
Okay. If we switch gears a little bit, maybe get out of the politics and economic side so much, something else that's really big going on, it seems like, and maybe not, but right in 2018, so kind of back to the period we're talking about, Powell comes in, starts trying to taper. We also saw the introduction, I believe it was around the same time and same year, of the SOFR. So trying to transition from the LIBOR to the SOFR. The LIBOR is set in London by a couple guys, good old buddies on the phone, and saying this is what we want it to be, kind of controlled by Europe. Again, that Euro banking, ECB centric, and now moving to the SOFR, which is based off the United States repo overnight rate. So one, it seems like there's a massive ticking time bomb if it doesn't go good. Do you see there's potential danger in switching all that debt over? Something that could go horribly wrong. It seems like they've delayed it quite a bit over the last 24 months.
They have, and you know, it had nothing to. LIBOR and the scandal that surrounded LIBOR really didn't have too terribly much to do with Euro bents or not. It was just people behaving badly, and I think one of the greatest challenges going forward is that you're going to have, I think the transition to SOFR is going to be fine in the end. Your danger is that you've got a lot of LIBOR paper that might be repricing at much higher rates as the Fed potentially becomes aggressive. So that, I think, is something to keep your eye on more than anything else. It's because so many things are based on LIBOR plus this, but they're existing contracts. The contracts aren't going to get closed out and moved over to a SOFR. No, the contracts are going to live their lives. And the Fed's behavior and how aggressive they are with monetary policy is going to have a bearing on those existing contracts. But I do think that the transition to SOFR will happen. There hasn't been a great uptake in the financial community, but that's just dragging of the feet. And it's also a reflection of the fact that we haven't had crazy lending going on in a post-pandemic world either.
Mm. How much of that is like under the control of the Federal Reserve and them driving this whole transition and change?
Well, I would argue that the world's biggest central bank should be the arbiter of such an entity until proven to be not the world's most influential central bank. I mean, at last I checked, 80% of transactions in the world were done on the dollar. So
yeah.
I
guess something that I'm just back to the economics of politics for a second is just it seems like the Biden administration is fully on board with this whole globalist green energy initiative, and yet here we have Powell and the Fed looks like they're kind of breaking apart from that. When I look at the pivot he had in 2018 and the couple claims he's made, disagreeing with Lagarde, and even trying to bring the whole LIBOR market back over to the SOFR market. So it seems like maybe there's this like diversion going on. Do you see that?
I don't see it through the same lens as you. I think that the Federal Reserve has the right to be the deciding factor on the global stage. It looks like Europe's going to go into recession with its formal interest rate, its overnight rate at a negative level for the second recession in a row. And my best way that I can describe Powell is that as soon as he's confirmed, and I think he's going to be confirmed by the Senate, he has the equivalent of veto power. And so when you notice a marked separation in terms of how the US Federal Reserve is approaching climate change compared to that of more progressive central banks, you need to see that as a reflection of the man with the veto power, as opposed to many who are on that committee who might be much more sympathetic. District banks, Federal Reserve district bank research departments have written, if you will, some very woke types of research.
Right.
But that's why it's critical that Powell retain his power seat. Even though, again, I've been extremely critical of some of the things that he has done, like bailing out the US bond market. So I think the pandemic and the real suffering because of high gasoline prices, I'm hoping that these two things, runaway inflation, thanks to fiscal spending gone wild, which is quietly the modern monetary theory crowd is just kind of, they've just kind of seeped off into the distance.
Yeah.
These are the things we have to be thankful for.
It seems like the world has gotten slapped across the face by reality a little bit, right? The MMTers got slapped across the face. The green energy people got slapped across the face and said, wait a minute, we still actually live in a real world where we need real things, right?
And by the same token, we've never had this level of consumer sentiment in the United States being as low as it is without the unemployment rate rising. And I keep saying that that as adorable as they are, everybody who thinks that they only need to be in the office on Tuesday, Wednesday, and Thursday, and that's if it's not raining, and that they dictate the terms of their employment. I keep saying that all you need is a rising unemployment rate, and that'll fix that as well. Right. So we could go 3 for 3.
Yeah. Well, a rising unemployment rate and a reduction in non-working bonuses and stimulus. So as long as the government keeps standing out that money for people to stay home, that's
right. But the midterms are coming.
Right. So what does that mean? That they're going to increase the amount of stimulus they're handing out? We saw, I'm in California and they're going to hand out $400 for every registered vehicle. And they're talking about that nationally. Seems like they want to hand out more money.
Yeah. Nationally, that's not going to happen.
Okay.
I mean, we can come back and chit chat about it, offline.
Well, in California, where I'm at, Governor Newsom is offering that to everybody, $400 for a registered vehicle.
I saw all the blood and details and all the guts of it. I said like a science experiment. I saw the whole thing. I will say that if Biden becomes desperate enough headed into the midterms and gets the idea, and it's been rolling around, of price controls in his head, that's going to be a problem.
Yeah.
And that would be an act of desperation that would come back to really haunt the US economy.
Yeah, well, we've seen a lot of talk and rhetoric of that. Of course, Elizabeth Warren started talking about it around Thanksgiving that it was turkey people were gouging. Then Biden wants to call and investigate the gas companies about gasoline price gouging. And so all those kind of hint to me that they want to consider price controls and gas. But yeah, it hasn't worked out well for anybody who's ever tried that.
No, he needs to just go back and Google Nixon price controls and see how that ended up.
Yeah. Yeah,
Not
it hasn't been good. Jumping into one more subject, getting out of the politics lens and just back to the economics, but maybe on a bigger world stage. Of course, the Russia-Ukraine situation is causing massive ripples or waves, tsunamis actually through the markets. Something that happened a couple weeks ago was that, well, first we saw in Canada, I think that the average everyday person realized pretty quickly that money in the bank wasn't actually their money and that it could just be frozen at any given time if somebody didn't like you. Not getting into the politics, whether that's right or wrong doesn't matter, but the fact that my money could be frozen at a given time. And I think that was a big, rude announcement, a slap across the face to most people. But then we saw if you're one of 3 global superpowers with nukes, like Russia, even your bank accounts get frozen and seized. And so we saw, their FX reserves get taken. And now it seems like the world's financial system has been rocked a little bit. I would just think if I was any other sovereign nation, certainly not Russia. If it could happen to Russia, it could happen to me. What do you think that does to the trust and the confidence for most people in the global financial system?
Well, now is definitely the right time to raise from the dead the 2017 headlines that Saudi Arabia would be accepting payments for oil and yuan. And what they did, they had a few of those headlines out just a few days ago. And I can tell you the stories in 2017 were even stronger than they are today. There is a chance that the United States is going to go down the wrong path. There's a chance. If anything right now, if you're talking about the world getting slapped across the face, China's had a very unfriendly reminder about how much it needs US consumers. Right? 68% of a $23 trillion economy.
It's a big number.
It's a big number. And they've got more than $1 trillion in US dollar reserves. So as enticing as it may be to have these types of discussions, if anything, right now, the dollar has just reminded the world how powerful it is. Unless you don't need it. If you don't need it, you're fine. But if you need the dollar for any reason, then you're going to do whatever it takes to stay on its good side, even if the United States is your sworn neighbor. That's what happens when you find out that your military might ally is more like a military Mighty Mouse. And God knows what's going to happen with my computer now that I just said that. But
the ads are coming.
But China has learned the hard way that it doesn't have the power that it thought it had when those photo ops were being taken advantage of at the Olympics with Xi Jinping standing by Vladimir Putin. I think that they saw their future in a different way than they did before. Is it dangerous to suggest that the US could strategically default on any given country's obligations? $100 billion of treasuries that were sitting on Russia's balance sheet, not being able to transact, even in gold? Sure. I mean, these are things that we will pay a heavy price for if we ever let the pendulum swing back towards modern monetary theory, universal basic income, printing with abandon. Those are the things that will make moments like freezing Russia's reserves come back to haunt us. As long as we move in the opposite direction, though, we're still in the power seat. And the rest of the world, especially the people about from like 2 to 5 a.m. who are like, the dollar's falling. It doesn't make them happy, but we've just reminded the world who's boss. And as long as they choose to issue debt in dollars, as long as 60% of the world's reserves continue to be in dollars, and as long as 80% of the world's transactions continue to be in dollars, the only thing the world is doing is validating our position.
So you think this has actually it's done more to validate the US dollar than actually to hurt it?
Oh, if you're speaking vis-a-vis China, the answer is yes. And you had an Arab nation agree to sell gas directly to Europe.
Well, China is in a problem because they don't really have the assets, right? They need to buy them. But if you have countries like Russia or Saudi, et cetera, so Russia's got the natural gas, they got the oil that the world desperately
China will
needs.
get all of it. China will be the beneficiary of that. China will be, even if it involves smuggling, right. China is going to benefit to the extent that they can with their proven allies.
Right. But to your point, you said that the dollar is only important if you need it. So Russia, if they get kicked out of the dollar system, they don't just go away and die. They learn how to get along without the dollar. And so they could demand to get paid in gold or whatever currency they want for that energy, because the world needs that energy. And I know we're all super dependent on each other, but it just seems like if I was having a party and I start kicking people out of the party, eventually I'm the only one left at the party. And obviously the US dollar is a long way from that. But it just seems like obviously global trade's being done in dollars, but as far as reserves, I mean, how much of your reserves do you want to keep in US dollars that your FX accounts could just be seized at any given time? So that lack of trust seems like it could really hurt the reserve at least. But you don't think so?
At the moment, I don't.
Okay.
And if China's economy was in an ascendancy right now, as opposed to slamming into a 30-year low and lower, I would have a different opinion. But we're simply not there. And don't get me wrong, the United States has been trying to trash its currency. I mean, It has been on a crazy train to nowhere with all of this crazy social spending that's been going on in the background. So we've almost won by default this particular battle.
Because China's so much worse off than us?
Because China's so much worse off, and because China's ally in this, i.e. Russia, is not what it was once perceived to be, outside of having a red button. I mean, they took out their own communication system. I mean, you can't try to do these. Militarily, they've proven themselves to be a complete disaster.
Yeah. And just talking about China for a minute then. So they've found themselves in massive problems, massive debt problems, energy problems, water problems, demographic problems, et cetera. Are those the reasons why you say that they're having maybe more problems than the US or anybody else?
Well, all of those things you just named are highly problematic in the middle of a over-levered property sector that's blowing up. Right. So yeah, China's got its own fair share of problems. It's not that China has not forged a lot of alliances. It's that they seem to be backfiring. So
Larry Fink the other day came out and said, I believe it was just a couple of days ago, said that this is probably going to be the end of globalism as we know it. The world is so tied together. To your point, China can't survive without the consumerism of the United States. We need supplies from everybody, kind of a thing. He sees it as kind of, that was the article, end of globalism. And as if we don't trust each other on this global monetary system, then we kind of have to resort to storing gold in my country, you store gold in your country, kind of a thing. But you think that's way overblown. You think the trust in the dollar, and not necessarily the trust, but the need for the dollar has actually grown and not been damaged.
Following Russia's invasion of Ukraine, that is the current takeaway. Again, look at how much debt Republicans have added to the balance sheet of the United States when they've been in power. I am not trying to make a political statement in any way, shape, or form. If something goes really wrong with the U.S. economy, all of a sudden that fiscal spending train can get back in motion. And it doesn't matter who's in power.
Sure, yeah. Each president spends more than the next, regardless of what party they're from.
Right, but it was the post-pandemic spending episode, however, that brought back the specter of inflation after more than 40 years. And that's the game changer in terms of how Americans view politics and how Americans view just opening up the public purse, because the inflation's come to hurt them. And they've begun to connect the dots. The San Francisco Federal Reserve, of all entities, came out with a study today that said that fiscal spending had contributed 3 percentage points to the growth of inflation. I'm like, that's Janet Yellen's old Fed. How ironic. But there is a growing recognition that all of this fiscal spending really ended up having a massive backlash effect on the economy in the form of real inflation that we haven't seen since Volcker stepped into office. And that, I hope, is the takeaway from this entire episode. It's that we've got to pull back on the fiscal side. And there's a bill in the House right now that would reduce the Fed from having a dual mandate to back to its single mandate. I'm all over that.
Of just inflation?
Of just inflation.
Wow. Is that gaining traction?
We really have learned, I mean, we really have. I've been tweeting it out. We've learned some lessons. We're like, whoa, if the Fed has the employment mandate, it's going to let inflation run wild. Maybe it shouldn't have both because they're inherently in conflict with one another. Well, you know what? There's a few congressmen who figured this out and they've put it on a bill. And I'm just going to do the best with my public persona to pump that bill. But maybe we end up with a few good things out of this.
Yeah. Well, I want to wrap it up here. I'm going to ask you one more question. Now, you're from Texas. By the way, Danielle will be speaking at my event coming up in Dallas, Texas, marketdisruptorslive.com. There's a link down below. But coming from the state of Texas, you talked about energy. I know you're into energy. Obviously, Texas is maybe probably the energy capital of the United States. And it's also turned out to be like the Bitcoin capital of the United States. I think I saw you say something recently talking about Bitcoin mining maybe, and talked about maybe you weren't really aware that it could actually be net positive for energy in the United States or in the world.
Well, I think what I said was I didn't know it was a thing. And then I hadn't realized that the big majors had found out that they could effectively sell off the
flare gas.
That was it. So now somebody sent me the story about ExxonMobil, and they're looking into doing what ExxonMobil does, which is make money.
Yeah. Taking that trash, right? So flare gas, well, that would either be vented or flared into the environment, is now that trash being turned into something of economic value, which is pretty cool.
It's certainly cool for ExxonMobil shareholders.
Yeah. Well, and it's good.
Anything you could, if it used to be pissed into the wind or burned into the wind, and that was to the detriment of Mother Earth, and now it's going straight to the bottom line.
So it's not just good for shareholders; it's good for everybody, right? If we can capture that and not let it leak into the environment, I mean, good. I mean,
and miners like to mine, so good.
You talked earlier about some of that stranded energy, and so you have this stranded energy. It's just stranded. There's no way to capture it. So this is a good opportunity for everybody.
It is. And I think we're going to be exporting a hell of a lot more LNG as well going forward. And those are some of the deals that we've also made following this invasion of Ukraine, is that we're going to sell more gas. We're going to put more gas that's pulled out of the ground in Texas and pump it into tankers and send it across the Atlantic. Woo, let's go.
So let me try and summarize things, and you tell me where I'm wrong here. I'm going to summarize what you've said or what I'm picking up, and you correct me because I'll probably get it wrong. But maybe this leads us to a little bit more energy independence in our own country, even exporting to the point you just said, which would be good for the economy. We saw what happened after 2008 when the energy burst into the scene. The Russia conflict actually wasn't as damaging as I might think. You think it could actually be somewhat helpful. China and the rest of the world kind of got put on notice that they need the dollar. The Fed stuck with a tough decision that could potentially hurt the markets in the short term, but would probably be better in the long term. So does that mean short-term pain for longer-term gain in your mind?
If they can channel their inner Volcker, it certainly does.
Yeah. Okay, good.
But again, I think your characterization was the best that there was. We're going to take it dot by dot.
Yeah, great. Well, with that, we'll go ahead and wrap it up, Danielle. I know you published the Quill Intelligence. Is there anything else that you'd like to point people to?
No, I'll have a discount code for anybody who wants to subscribe after the event in Dallas. So if they want to reach out to me at Danielle@DiMartinoBooth.com, they can feel free. I can give them that conference code earlier. Yep, great. And then we'll make sure we'll link that in the show notes down below. And with that, we'll go ahead and sign it off. Thanks so much, Danielle. Appreciate it. Appreciate it. All right, that's a wrap. Hope you enjoyed that interview with Danielle DiMartino Booth, former Fed insider. So many different directions we could have gone. That interview could have gone forever. We could have dug into each one of those topics. But
That's why you need to come see her live and in person to see her full presentation, see all her slides so she can back it up, give you the receipts, as we like to say. So come see Danielle DiMartino Booth at my live event, Market Disruptors Live. Join her and about 15 of top experts around the world. We're talking about other experts like Luke Grumman, George Gammon, Jeff Booth, Harry Dent, of course myself, and so many others. Do not miss out on the chance to come see us. There's a link down below, marketdisruptorslive.com. Of course, as always, give me a thumbs up on this video if you like it. And if you don't like the video, that's okay. But give me a thumbs down and at least leave me a comment and let me know why. And I hope you enjoyed it. To your success, I'm out.